Guys, as I have promised you in my previous technical analysis, the weekly technical analysis and the midweek updates, I am going to give you the outlook for the year 2022 of S&P 500 Index. Through this yearly outlook, I will answer the most common questions that many of you have asked through the comments or through the email. Someone asked me that what are the chances that we are going to see another depression after almost after 100 years. Okay, so the last depression that was there, it was from 1929 to 1940. Then some of you have asked that what are the chances that S&P 500 will regain its bullish movement by the end of 2022. Then yes, this is the most common question that people wanted to ask, that whenever there will be a retrace, whenever there will be a rebound, then to what levels the S&P 500 will retrace. Now some of you have asked that what are the chances that S&P 500 can hit 4,800, means the all-time high of the S&P 500 index, by the end of 2022. Now this was the most uncommon question, okay, that only a few people have asked, and these few people, they have some good knowledge, okay, of the technicals. So they have asked that what are the chances that S&P 500 index can hit 2200 by the end of 2022. Okay, see, currently S&P 500 index is trading around 3600 or 3700. Okay, and coming down to 2200 means losing another 1500 points, 1500. So only after losing 1500 points S&P 500 index can come and hit 2200. Then the next question was that is it possible if the S&P 500, okay, rather than coming down heavily, if it is possible that the S&P 500 index can move into the long-term consolidation. Consolidation means just up, down, up, down, up, down, neither bullish nor bearish. Okay, so a long-term consolidation. So guys, I am going to answer all of these questions, okay, and also I will cover some other aspects of the S&P 500 index, and we will see that what is going to happen in the year of 2022. So today is June 20th 2022, okay, and there are more than 6 months to go. So two quarters are there, okay. So we are going to see what is going to happen to the S&P 500 index for the rest of the year. So whatever I'm going to cover, I will cover through the technical indicators and the geopolitical factors that is affecting or that is being reflected by the technical indicators. And this is how we are able to achieve more than 80 to 90% of accuracy. So guys, make sure that you do not skip the video. And secondly, if you have not subscribed the channel, then subscribe the channel and click on the bell notification icon, so that whenever I upload the weekly technical analysis and the midweek updates and the informative videos like this, so you will get an instant notification, okay, and you can prepare yourself in advance. Guys, let's first talk about the problem. We need to know the problem, okay, the reason that why the markets are coming down, not just one market but the worldwide markets. And because the markets are coming down, we are in recession. So this thing is what I told you in the first week of January, first and the second week of January 2022, that year 2022 is the year of bubble and the recession. We will enter into the recession, the bubble will burst, and the S&P 500 will fall by a minimum of 20 to 25%. Now when we talk about the problem, there is not just one problem, but there are multiple problems. Okay, the very first problem, or the most important one, is this: the United States inflation rate, okay, and the ticker is USIRYY. Okay, this is the ticker. So this is showing us the inflation rate. Okay, so inflation, as you can see, okay, in your real life, okay, what you can see is that the gas prices are almost or the gas prices are more than $5 a gallon, okay, whereas the same prices were almost like $3 1 year ago. So in June 2021, okay, the gas prices were $3, and in June 2022, the gas prices are almost more than 60-70% $5. See, everything or most of the things are directly influenced by the rising fuel prices. So this is the simple economics. So we were talking about the problem. Now let me show you the problem very clearly. This is 2008. Okay, the Great Recession, 2008. In 2008, the inflation peaked to 5.60 only. This was the maximum. Okay, the inflation peaked in the Great Recession of 2008, 2007 to 2009. Okay, 5.60. Now you can see that this is the live chart. Okay, and we are at 8.60. 8.60. This is the current inflation in the year 2022, June 2022. This is 8.60. Okay, earlier there was there was this high of 8.50 in the month of March, or by the end of March. Okay, the inflation was 8.5, and this triggered a reaction, a chain reaction. Okay, and this is what created the fear worldwide, especially in the central banks. Okay, that the inflation has hit this the 8.5. Okay, but now we are seeing 8.6. 8.6 is more than 8.5. Now the concern is that this is still rising. This is still rising. This is not coming down. Okay, and this is the reason why the central banks are increasing the interest rates heavily. Recently, on June 15th, the central bank, the Fed Reserve, has raised the interest rate by 75 bps. Okay, in the month of May, the Fed Reserve has raised the interest rate by 50 bps. Okay, so in the month of May, the Federal Reserve was saying that we are raising the interest rate by 50 bps, and we are not considering the 75 bps. Then just after 1 month, the Federal Reserve has raised the interest rate by 75 bps, and now the Federal Reserve is saying that we are not considering the 100 bps. Okay, so this the hike in the interest rate, okay, by like additional 25 bps. So it is putting a lot of pressure on the markets. Okay, because by raising the interest rates, okay, the bond yield, the bonds, okay, the bond yield is increasing, and whenever the bond yield increase, so bonds are the safest thing, okay, that the institutional or the big investors, they think of. So when the bond yield increase, so investors, okay, they withdraw the money from the market and they buy the bonds. This is what they do, because whatever is mentioned in the bonds. So for example, okay, if an investor see that there is a 5% confirmed return, assured returns from the bonds, okay, whereas the stock market is risky, so the investor will transfer his money from the stock market to the bonds. Now the question is that how big this problem could be in the coming days. Okay, as of now, the inflation rate is 8.60, and it is moving up. It is continuously moving up. It is not coming down. Okay, and it has recently surpassed the 8.50. This is again, see, technically it indicates that inflation is further going to move up. Okay, so even though the Federal Reserve has raised the interest hike, raised the interest rate by 75 bps, but still, okay, in the coming days, technically we are expecting this to move up, because it has recently breached the 8.5 level and it is trading at 8.6 level. Now how worse it could be. Now in order to see how worse it could be, let's see what the technicals are saying at the moment. At the moment, okay, all of the technicals, okay, see, if you subscribe to my channel and if you are watching my technical analysis, then now you might be very much familiar with how I do the technical analysis. Okay, so if you look into the moving averages, clear fan out supporting the bull trend above the 200-day moving average. Okay, and other than that, okay, there comes the MACD. MACD is bullish. Okay, so it was trying to hold, but the MACD is bullish. Then comes the stock RSI. The K channel is less than the D channel, but both are above 90. Okay, remember both are above 90, and you know what happens when both are above 90. Even if the K is less than the D, it is considered bullish. Okay, then comes the divergence, all-time high, all-time high. Okay, and if we move back to the history, then this kind of divergence was seen. Okay, currently it is 81.03. This was seen in 80s. Okay, 1980s, and no, not in 74, then 1980s, then there, and before that it was seen in 1946. Okay, then it was 1942 or 1934. Okay, so only a few times, only a few times. Now why it was seen, okay, this much heavy in 1980s? Because in 1980s, when the inflation was super heavy, so the president at that time, okay, asked the Federal Reserve Chairman to do whatever he can in order to curb the inflation. So what the Fed chairman did at that time, I forgot his name. Okay, so what he actually did, he stopped printing money. He stopped printing money, and he increased the interest rates heavily. Stop printing more money and increase the interest rate heavily, and that worked. How? Okay, so this worked like this, that the inflation, okay, that was soaring, okay, to like 85.91. If we look into the divergence, okay, that was, sorry, not the divergence, if we look into the inflation itself, so that was like 12 or 13, 14, sorry, 14, 14.70, 14.80. So the inflation, okay, it came down. So it was 14 or something, then inflation, okay, it came down. Okay, so this thing, it helped at that time, but also it created, or it built a recession. So there was a short recession in the year of 1980. 10% of the people, okay, they were jobless. Okay, but this was necessary at that time to stop printing more money, to stop the flow of the money in the market, and to raise the interest rates, so that people resist, people do not spend more money. Okay, this is what the central bank or the government wanted to, that people stop buying more things. Okay, and people use the money wisely, so they stop printing money, they control the flow of the money in the market, they raise the interest rates. Okay, that resulted in a recession, confirmed recession. There was a recession. 10% of the workforce, okay, was jobless. People, okay, so it means that was the bad time. But after 1980, okay, then the economy, okay, it went smoothly. Now the question is the same thing is going to happen again in the year 2022? So let's see if that is going to happen. So as you have seen that the technicals are bullish. Okay, technicals are supporting the bull movement, means technicals are supporting the increase in the inflation. Okay, now the immediate resistance that comes to this, the inflation, is 9.73. 9.73. Now what does that mean? This means that currently you are paying $5 per gallon, okay, for the gas, right? When the inflation hits 9.73, then most likely you are going to pay $5.5 or maybe like the $6 per gallon. Okay, this is what will happen when the inflation hits 9.73. Okay, and other than that, whatever you are going to buy, everything, okay, the price will be increased by 10% to 20% or maybe 25%. So now we are expecting that if the inflation is not controlled, okay, immediately through any means, in that case inflation is going to rise to 9.73, and when the inflation hits the 9.73, then only we can expect it to cool down. So most likely you will pay $5.5, okay, or $6 per gallon to buy the gas, okay, immediately. Means in the immediate future, like in the month of July or in the month of August, okay, because the inflation is expected to move up. Secondly, the Federal Reserve, okay, earlier it was saying that the Feds are in no mood to increase the interest rates by more than 50 bps, but they raised the interest rate by 75 bps. This means that you cannot rule out that Fed Reserve cannot raise the inflation, cannot raise the interest rates by 100 bps, because it is the job of the Feds, it is the duty of the Feds, okay, to bring or to keep everything in control, okay, the prices, the inflation, and each and everything. So now you know that this inflation, okay, it is creating a problem, okay, and because of the inflation, okay, Federal Reserve is raising the interest rates, okay, and the increase in the interest rates is means the increase in the bond yields, and because the bonds are more attractive, okay, than the stocks, so the institutional investors, the big investor, they are withdrawing the money from the stock market and they are buying the bonds, and because they are withdrawing, you know, very heavy money from the market, markets are coming down. See, so this is one of the reason, okay, why the stock market is coming down, why the S&P 500. So we were talking about the S&P 500, why especially the S&P 500 is coming down. Now some of your questions are answered here, okay, and that was number one, what are the chances S&P 500 will be bullish by the end of 2022? So the chances are less than, sorry, the chances are less than 1%, less than 1%, because you know that inflation is moving up, okay, and in order to curb the inflation, raise the interest rates, okay, and when the Fed raise the interest rates, the market movers, they will withdraw the money from the market, okay, and then they will pump this money into the bonds. Because they are withdrawing the money from the market will come down, okay, and because the S&P 500, it is already bearish, okay, this means that by the end of 2022, chances of being bullish are less than 1%. Now this also answers your second question, then can S&P 500 index hit 4,800 by the end of 2022? Again, the chances are less than 1%, less than 1%. Now the question that is it possible if S&P 500 index can move into the long-term consolidation? Okay, so I will answer this question once I cover a few more things, but as of now, okay, I've answered question number 4 and question number 2, okay, about being bullish. Now because we are talking about the yearly outlook, okay, for the year of 2022, and we are in the middle of the year, okay, this is June 20th, okay, 2022, and two quarters to go. So whenever we are looking for the yearly outlook, okay, we need to look into the big picture, like what is happening, okay, through the longer time frames. So when I say longer time frame, I mean that we are going to look into the weekly or the monthly time frames, okay. So guys, this is the weekly chart, okay, but my focus is not on the weekly chart, but still there is something that I want to show you, okay, and the people who have subscribed the channel, okay, and through my midweek updates and the technical analysis, they already know this thing, that this is the 200 week moving average, 200 week EMA. And on 16th of June and on 17th of June, when the market came down, it hit the 200 week moving average. Then there was a retrace, okay, and because this happened, so on 17th of June, okay, a lot of people following my advice have made some good money, particularly a lot of money in options, okay. So if you see that the market was moving up, and then it came down, and finally it was a 200 week moving average which gave a very good support to the market. Now what is expected to happen in the next week of June 2022, etc.? So I've already mentioned in my previous in my recent weekly technical analysis that you can watch, okay, and also I will give you the midweek updates so that you can avoid making mistakes and you can make money. So this is what I wanted to show you. Now there is a reason why I have told you this again, okay, the 200 week moving average. So for that we need to look into the monthly chart. So guys, this is the monthly chart, okay. One candle means 1 month, not 1 week or 1 day. One candle means 1 month. Okay. Now, if you are familiar with the technical indicators, okay, or the charts, or even if you are not familiar with the technical indicators, then also you can notice a problem, that there is a problem in this chart. Okay. So the problem, if you have noticed, then let me tell you, the problem is here. Okay. This is the 200 months EMA, the moving average, the 200 months moving average. Okay, and this was the reason why I have shown you the 200 week moving average. Okay, now if you see that market, in the month of January, okay, December, January, when the market has formed the all-time high of 4818 and 4808. Okay, so there was a very heavy divergence between the monthly EMA, 200 week monthly EMA, and the market. Okay, and this was the reason, means this was just one reason, but there were other reasons. This is why I told you in the first week of January and the second week of January that year 2022, okay, will be the year of the bubble. Okay, the bubble will burst, and also the year 2022, okay, will be the year of recession. Okay, so I have already warned you, I have informed you very well in advance. Now if you notice that the closing of the market was 3674 on 17th of June. Okay, this is the month of June. Now in the month of June, okay, it is 3674, and if you see that the 200 month moving average is at 2354. Okay, it is at 2354. This means that and also you can see that the market is coming down. This means that the difference in the closing price of the market and the 200 month moving average is almost, or is more than 1200 or 1250 points. Okay, this also means that yes, the market has potential to come down to or to lose, another 1200 points and to hit the 200 month moving average. Now in order to confirm the same, okay, let's see what the technical indicators are saying. If you look into the Bollinger Bands, lower band, median of the Bollinger Band, market has closed between the lower band and the median, means the market is bearish. If you look into the moving averages, okay, there is still no crossover, but because the market is trading below the moving averages, and if I repeat, and if by the end of June, okay, if the market closes below all of these, the moving averages, as of now the moving average, the green moving average, it is at 3979. Okay, so if the closing of the market remains below 3979 or 3900, in that case it will be a confirmation that because the market has closed below the moving average, this means the market is partially bearish on the monthly chart. Remember, this is a monthly chart. Okay, now Ichimoku, only the Ichimoku is supporting bull market. Okay, other than that, if we look into some other technical indicators, MACD clearly bearish, not just clearly but heavily bearish. Okay, because the MACD is less than the signal. Okay, and there is very heavy divergence. Then comes the stock RSI. Stock RSI is clearly bearish, not just bearish but heavily bearish, and the K channel is 0.01. Okay, if you have watched the midweek update on June 14th and on June 15th, okay, then you will see what I've told you about the K channel. Okay, so K channel is 0.01. And then comes the divergence. So earlier the divergence was increasing and it was very heavy, but now the divergence is in control. Then comes the volatility. Volatility, just like the weekly chart, okay, volatility is again all-time high on the monthly chart. It is almost 340 on the monthly chart. Okay, so now through all of the indicators except the Ichimoku cloud and partially through the moving averages, okay, market is bearish. But as of now we cannot say that the market is heavily bearish, but don't worry, the market will be heavily bearish soon. okay, maybe in the month of July or in the month of August, okay, you will see that the market is heavily bearish. But momentarily there will be a rebound in the market, because if you see that the divergence is heavily increasing, okay, in the MACD there is very heavy divergence, and market can never show this much of heavy divergence. Market is not allowed to show this much of heavy divergence. This means that momentarily, okay, in like in a few days or in a few weeks, you may see that the market is retracing or rebounding a bit. So now this answers your another question that you were asking, that what are the chances that the index will hit 2200 by the end of 2022. Okay, so the chances are less than, you can say, like less than 10 or 20%. Okay, not 1%, but less than 10 or 20%, because as I have shown you that the 200 months moving average, the 200 months moving average is currently trading at 2354. 2354. Okay, so most likely market will come to 2354. Sorry. See, by the time the market comes to hit the 200 months moving average, the 200 months moving average, okay, will increase, means the value will increase a bit. Okay, it may be like 2400 or 2400 something, okay, or so. And so by the time the market hits the moving average, so this will be the approximate value, but that does not mean that market won't be able to breach, okay, the 2400 levels. The market will certainly be able to breach if the inflation, by the time, if the inflation is not in control, okay, and if we are seeing stagflation continuously. Okay, stagflation means that the inflation is continuously rising up, okay, it is moving up, inflation is increasing, but the purchasing power, okay, the buying capacity of the buyers are decreasing, okay, that purchasing power is decreasing, okay. So that will further trigger, so that will allow the market to breach the 200 months moving average, okay, and then the market may come down to hit the levels, okay, the levels of that we have not seen since 2008, okay, the Great Recession. In the Great Recession, okay, of 2007 to 2009, okay, we have seen that before the fall, okay, the market was trading at 1576, so that was the all-time high, 1576. S&P 500 formed an all-time high of 1576 in the month of October 2007, okay, and then in the month of March 2009 the all-time low was 666. Now you can clearly see that the market has lost more than 60%. Okay, more than 60%. 1576 to 666. And also you will notice that the market hit the 200-month moving average, reached 200-month moving average, and came well below 200-month moving average. Okay, this is why I have mentioned that there are less than 10 or less than 20% chances that the market will come and hit 2200, because see, as of now the situation is different, okay, than that of the 2008, because as of now if the market comes to hit 2200 or 2000, that will be bad for the overall economy, because as of now there is a lot of globalization, okay, and the depression that has happened only once in the history, from 1929 to 1940, okay, because if the market comes down to like 2000 or below 2000, then we cannot rule out the depression. So it also answers that what are the chances of seeing another depression after 1930. So again the chances are less than 5%, okay, less than 5%. Why not 10%? Why not 1% less? And why only 5%? The reason is that no government, no institution, no private institution would ever like to see another depression. Okay, so I will make another video, a separate video about the recession and the depression, okay, what can happen if the depression comes, okay, and what will happen to the recession. But as of now, you can say that if you own a car, okay, a Tesla car, where the market value of the Tesla car was $100,000, okay, if you want to sell this car in recession, okay, then you can sell it for like maybe like $50,000, okay, 50 or $40,000, okay. So you can get $40,000 to $50,000 for the car, okay, in the recession. But if there comes a depression, then you will be selling your car, okay, only for like $10,000 or just $5,000. But even after selling it, or even after telling someone that I am ready to sell my car for $5,000, no one would be willing to buy it for $5,000 or as low as $1,000. So the $100,000 car, okay, will be worth like just $1,000, maybe just like $500, okay, when there will be a depression. Now pray that you do not see another depression, because depression will be really very, very bad. Because when there will be a depression, then you will be not looking for an iPhone, or weekend trip to some other country or something. Rather, you will be looking for your bread and butter. Now as I mentioned earlier, that I will make another video on this, the recession and depression, okay, completely. In that video, through technicals, I will tell you, okay, when there will be chances that we can enter into the depression, and when we will be entering into the depression, then what will happen to the S&P 500 and the other indices, okay, and what will happen to the overall economy of the world, not just for a country but overall economy of the world, okay, which country will suffer most, okay, and which country will suffer least, or who will suffer most and who will suffer least. So that will be all there in the video of recession and depression. Now let's see what has happened in the Great Recession of 2007 to 2009. If you see that movement of the market, okay, the movement, so see, when I say market, I mean the S&P 500 Index, okay. So if you see that during that particular the Great Recession of 2007 to 2007 to 2009, okay, the market has lost more than 60% of its value, okay. Then it came down, and one thing that you will notice, that market did not, on the monthly chart, remember we are talking about the monthly chart, on the monthly chart, okay, market did not enter into the consolidation. The market was coming down, okay. Once it came down to certain level, then it moved up, okay. So there was no consolidation, okay. So this means that when this thing happens, and not just when, okay, but this thing is happening now, because the thing is happening, so we cannot say that the market will come down and then the market will enter into consolidation, market will hold. See, I'm talking about the monthly chart. You can see the consolidation on the daily chart, okay, that is normal. Consolidation on the daily chart means like for the continuously for 10 days, continuously for like 20 days, or for like 30 days, the market is in consolidation. That may happen on the daily chart, I'm not ruling out. And for that, make sure that you have subscribed the channel, okay, and also make sure that you click on the bell notification icon, so that whenever I give you the technical analysis, the weekly technical analysis and the midweek updates, there I will inform you, okay, if I see that a consolidation is coming, so I will inform you. But that consolidation, okay, through this, the historical, by reviewing the historical data, that consolidation will not be seen on the monthly chart, because if the market moves into the consolidation, okay, on the monthly chart, that means, okay, it has to be like this for a few months, for 5, 6 or 7 months. And because the market is bearish and in control of bears, inflation is rising, everything is messed up, okay, so to be in the consolidation, or the chances of being in the consolidation, are very, very less, very, very few, okay. So now this also answers, so this answers your question, okay, about the consolidation, the long-term consolidation. No, So there are just less than 1% chances that the market will move into the long-term consolidation. A short-term consolidation, yes, that may happen. 7 days, 10 days, 20 days, 25 days, that is normal, that may happen. But a long-term consolidation, 2 months, 3 months, 4 months, no, that is not going to happen. Now you are watching this video, and the reason is that you want to know what is going to happen to the S&P 500 index, okay, in the year 2022. And also either all of you or most of you are trading in the S&P 500 index. And when you are trading in the S&P 500 index, okay, you want to know the support and the resistance levels, okay, and also you want to know that whenever the market comes down, then to what level, okay, it will find very good support, and after finding that particular support, to what level the market will bounce back. Okay, so now we are going to talk about this, the question number 3. Okay, in the best case scenario, to what levels, or not just the best case, but in a general scenario, to what levels the S&P 500 can retrace. Okay, so these are the support and resistance levels, okay, I have mentioned at the right hand side. Now as of now, I am not expecting the S&P 500 to retrace to 4529, and I have mentioned various reasons why. Then comes 4288. Okay, it is not 4288, it is 4291. Okay, in an exceptional case, okay, market may see a retrace to 4291 only in an exceptional case. However, this is unlikely to happen. Again, this is unlikely to happen. Okay, then comes the 4033 or 4055. Yes, this is something that may happen. Okay, 4035. See, today is okay, it is June 20th, and June 20th 2022. Okay, and the market closing of the market is 3674. And also that in the beginning of the video, I have shown you that the market, okay, it found some very good support, okay, after hitting the 200-week moving average. So whenever the market see a retrace, a rebound, okay, so and if this rebound is fueled by some other good news, okay, then at most the market can come to hit 4035. Okay, and in an exceptional case, that is most unlikely to happen, 4291. That's it. Okay, but we are more focused on the bear trend. Okay, because now the market is in control of the bears, and if the market breaches the 4035 or 4291, in that case bulls will regain the control of the market, and that is something bears would never want. Anyways, the next immediate resistance comes at 3845. This is 3845 or 3840, you can say 3840. Okay, and the magic of 3840 I have shown you in the previous technical analysis and in the midweek update. Okay, then comes 3628, okay, or 3630. 3630 is the immediate support. I repeat, immediate support. And okay, today, okay, it is June 20th, but the market may hold around, or may hold above the 3630 only for a few days, but eventually the market will breach 3630. Okay, then comes the next support at 3392. Okay, 3392 or 3393. But in my previous or in my recent weekly technical analysis, I told you that there is a support at 3415. So market will come down, okay, and before it actually hits 3393, market will hit 3415, and then after hitting the 3415 or the zone of 3415, market will see a rebound. Okay, anyways, then comes 3141 or 3140. Again, I repeat that whatever these levels are, whatever I'm telling you, for example 3140, support and resistance are not the absolute prices, are not the absolute levels. Rather, support and resistances are the zones. Okay, a zone where the market travels like this, okay, or the market behaves like this, up down up down up down. Okay, So when I say 3410 or 3393 or any other support or resistance zone, plus minus 10, plus minus 10, plus minus 10, okay, in some cases 5 or in some cases 15, okay, but plus minus 10, so that will create the zone for means that particular support zone or the particular resistance zone. Okay, after 3140 then comes 2943, 2943 or 2940. Okay, so yes, the market is expected to come down to 2940, okay, in the year 2022. Okay, and not just 2940, then we have 2642, 2640. Okay, then comes 2309, 2309 or 2300. And as I mentioned that currently the 200 month moving average is at 2354, 2354, and by the time the market comes to hit the 200 months moving average, okay, it will be like July, August, or maybe like September or maybe October. It depends that what will be the pace of the market. Okay, so the market will come down and market will hit the 200 months moving average. So that will be somewhere, okay, in the zone of 2300 to 2640. Okay, so market will be somewhere around 2400, okay, or 2450 or something. Okay, maybe like this level or this level. Okay, so now, so these are the support and resistance levels. Other than that, okay, we have some other support and resistance levels, and these are the very risky levels, extremely risky levels. This is 1943, not the year 1943, okay, or you can say 1945. This is the support, 1945. Then we have 1669, 1670. Okay, now I'm not expecting as of now, and I pray that market, whenever the market comes, okay, the 200 months moving average must be able to provide very heavy support to the market. Because the reason is, if the market breaches the 200 months moving average, come down to 200, 300, that is fine. But if it comes down to 1945, okay, then if you calculate, the market will lose almost 60% of its value, 60%. Okay, and as I've shown you earlier, okay, that in the Great Recession from 2007 to 2009, market has lost 60% or more than 60% value. Now the depression that we were talking about, okay, if the market comes and hits 1670, 1670, that will be an early indication or a clear indication market is going to enter into the depression. It has covered, if or it has left behind the recession, the great recession, and now it is going to enter into the depression. While the recession lasts for like 2 years, 1 to 2 years or 1 to 3 years, the depression lasts for 10 years or 10 to 12 years. The last depression that was there in, it was 1929 to 1940, okay, 1941. So more than 10 years, and that will be extremely bad for the economy, bad for the governments, bad for the world, okay, bad for all of the people. This means that we cannot rule out that market can come down and hit 2300. Yes, certainly the market can hit 2300, okay, or it will, or the market will be able to see a very heavy support around 2400, okay, something. But yes, the possibility is the market can come down to hit 2300 as long as market is within 60%. Okay, that's not a problem, because market has already seen that the loss of 60% in the Great Recession of 2007 to 2009. Okay, so 50% to 60% market can digest, because market has already seen that. Okay, but beyond 60% will be something that market won't be able to digest. Now to answer your question, okay, on the rebound, that to what level the market will rebound, okay, I'm going to use the Fibonacci retracement. So as of now, as of now, telling you to what level the market is going to rebound, okay, in the year of 2022, it will be just, extremely foolish, okay, because no one can tell that to what level the market will rebound in 2022 until and unless you know that to what level it will come. It will certainly come and hold. No one knows as of now that to what level, what will be the exact level, okay, to which the market will come and hold. Because once we know the level, then only we can tell you, okay, or then only someone can tell, okay, exactly to what level the market can retrace. Okay, so what I'm going to do is that I'm going to show you that how we are going to look into the retrace through the Fibonacci retracement. Okay, so I have made a video on the Fibonacci retracement strategies. Okay, and so you can watch that particular video if you do not know, okay, how to use the Fibonacci or what are the retracement strategies. So if I look into the current scenario, okay, in the present scenario, and if you see that as of now, okay, market, this is the situation in the market. So if we say that market is not going to come down, okay, any further, in an hypothetical situation, in this example, okay, everyone knows that market will come down, but I'm going to show you that if the market is holding as of now, okay, to this current level, then from the high to the low, if we do the retracement level, then the initial retracement of 23.6% comes out to be 3915. Okay, then thereafter comes the 4089. Okay, then thereafter comes the 4229. So these are the retracement levels through the Fibonacci retracement. I am not saying that the market will retrace to these levels. Rather, I am simply telling you that whenever the market comes down, all you need to do is to use the Fibonacci retracement. Okay, and the Fibonacci retracement will tell you that to what levels the market is going to retrace. As of now, no one can say, or no one can tell you that to what level the market will retrace, because the market has not touched the bottom. The market has not shown you the bottom yet. Once we know the bottom, then only we will come to know that to what level it is going to retrace. But yes, intermittently there will be the retraces, there will be the rebound, there will be the rebounds. Okay, the market is coming down, the market will, for sure, the market will bounce back. Okay, this bounce back will form a lower high, will give you an opportunity to sell. Okay, now this lower high will be formed, okay, because of the retracement only. And this lower, and in order to see the retracement levels, okay, in order to see that to what level the market will retrace, okay, you must not look into the monthly chart, rather you should look into the daily chart. So in order to see that to what level the market is going to retrace to form a lower high, you should look into the daily charts, daily candles, and then you can say, okay, in next 7 days, or in next 2 to 3 days, or in next 5 days, or in 10 days, the market is going to retrace. But if you say that in next 3 months the market is going to retrace to this level, this is absolute foolish. Okay, this is 100% false, this is 100% untrue. No one can predict that. Now this answers your question that to what levels, okay, the market will retrace, okay, in the year 2022. So these were the questions, okay, that I have covered for you. Now if you have any more questions, okay, for the year 2022, so you are welcome to comment. And if your questions are logical, okay, in that case, then definitely for sure I will make another video like part 2 of this video, and I will answer your questions, okay, the questions that you will ask through the comments, then I will answer your questions, okay, in that part 2 of the video. Okay, so you are welcome to comment. So guys, if you have not subscribed the channel, then make sure you subscribe the channel, okay, and click on the bell notification icon. Don't forget to click on the bell notification icon, otherwise you will not get the notifications when I upload the midweek update and the technical analysis and such informational outlook videos and other informational videos. And also if you are trading actively in the S&P 500 index, then you have seen that the accuracy through the midweek updates is more than 90% or 93%. So make sure that you do not miss the midweek updates. So the midweek updates will tell you what immediately is going to happen on that particular day and the next subsequent day. Do share so that your friends or colleagues can also learn a lot of new things, okay, can also see what is going to happen in the immediate future, okay, in the year 2022. And I hope that you have learned a lot through this video, okay, not just about the technicals but about the other aspects of the market. And I hope that this video was quite informative. So again, do not forget to like, share, comment and subscribe.